Okay, so today we are going to be looking at reporting. This is lesson 9. We're going to look at reporting. So after the audit is done, we've carried out the substantive testing, the test for controls, we've gathered all the evidence that we're looking for. Then we need to write a report. So in this particular topic, we're just going to look at all those aspects that are done at the end of the audit when it's almost done preparing the report and the audit opinion that we need to express. So firstly, what we need to understand is what is called subsequent events. So subsequent events in financial reporting, it's covered in IAS 10, International Accounting Standard 10, right? So what are subsequent events? So subsequent events are events occurring between the end of the financial year and the date of the auditor's report and the facts made known to the auditor during that period. So subsequent events are all those events that occur between the end of the financial year. So if the financial year is ending on 31st December, so from 31st December, then the audit report is going to be issued maybe on 31st March. So that period from 31st December to 31st March of the following year is all the events that occur during that period are what we call subsequent events. And all the information and facts that are made known to the auditor in that period or encompass the subsequent events. So we need to look at IS10. What does IS10 talk about, right? IS10 talks about events after the reporting period, right? And it classifies those events into two. There's adjusting events as well as non-adjusting events. So one, adjusting events are events which provide evidence of conditions that existed at the year end. The non-adjusting events are events which are indicative of conditions which arose after the year end. So adjusting events, these are like events which are evident, like these are events which like they are okay, they are evident, like they've happened. So for instance, we've got receivables of 1 million. Then out of what that 1 million, we've got a person, a company rather, that owes us, say, 200,000. And our year end ends on the 31st, right? And then that particular receivable goes bankrupt on the 29th of December. So that particular event is evidence, right, that we won't receive the receivable. We won't receive the amount that that particular entity owes us. So what do? We need to adjust the receivables figure in the statement of financial position because we will not receive that money. Why? Because it's evident that that receivable, that customer has gone bankrupt, right? Then non-adjusting events. So non-adjusting events where the year ends, right? The year ends, 31st December has come to an end. Then maybe on the 2nd of January, the following year, the warehouse burns, goes into flames. Then we lose maybe 50,000 worth of inventory. If we've got maybe 200,000 worth of inventory, then in that warehouse, 50,000 quarter worth of inventory uh, gets bent and damaged, right? Then in that moment, that event, since it has happened after the year end, we've already counted the inventory. We don't really need to adjust the inventory figure in the financial step into financial position. All we need to do is we need to uh, put in place an adjustment, or rather a note in the financial statements, which states that no, such and such an amount of inventory was destroyed after the year end. So these are adjusting and non-adjusting events. So for adjusting events, these conditions, when they happen, they lead to adjustments in the financial statement. But non-adjusting events, these just leads to um, disclosures in the financial statements. So now this is where we go to the objective of the auditor. What is the objective of the auditor with respect to subsequent events? So the objective of the auditor is to obtain sufficient appropriate evidence that adjustments in the financial statements for adjusting events have been made and disclosures have been made or have been provided for non-adjusting events. Then two, the auditor needs to respond appropriately to facts made known to the auditor after the date of the auditor's report, which otherwise would have led to the change in audit opinion or audit report had that information been made known before the release of the audit report. So the auditor has got two objectives with respect to subsequent events. So the first is to obtain sufficient appropriate evidence that um, adjustments have been made with respect to adjusting events, right? And disclosures have been provided uh, with respect to non-adjusting events. Because remember, adjusting events, adjustments need to be done. They need to be provided for in the statement of financial position or any other item in the financial statements. Then non-adjusting events, a disclosure is what is supposed to be made, right? So now the auditor's job is to make sure that or it obtains sufficient appropriate evidence that those adjustments which are required uh, are provided for, and those disclosures which are also required with respect to non-adjusting events are also provided for. Then two, the auditor needs to respond to the facts which are made known to them between the date of the auditor's report and the date of the financial statements. So all the facts that are made known from the time the auditor releases the auditor's report to the time when financial statements are issued or authorized, the auditor needs to respond to all those conditions in that particular period if they were made known before the audit report was issued, they could have led to changing in the structure or the opinion that's expressed in the report. So now, the auditor has got two types of duties. There's the active duty as well as the passive duty. So the active duty is a period between the date of the year end and the date of the audit report. So from the date when the financial year comes to an end to the date when the audit report is released, that's called active duty. Then passive duty is the date after the audit report is released to the date when financial statements are published, right? So in that period of passive duty, the auditor has no obligation to carry out procedures on financial statements adjustments whatsoever, unless the facts that are made known to the auditor in that particular period would have led to change in the report, right? If those facts that are made known to the auditor could have led to the auditor making or expressing a different opinion or changing some aspects of the report, then those particular events and conditions are supposed to be responded to by the auditor. All right. So now, how does the auditor respond to subsequent events? So, for facts which are discovered after the date of the auditor's report but before the financial statements, for which, if the facts were made known earlier, they would have required the auditor to amend the audit report. Firstly, the auditor must discuss that matter with management or, where appropriate, with those charged with government. So the first step is discussing with management. Then the second step is to determine whether the financial statements are going to be amended. And once the auditor establishes saying, okay, the financial statements will be amended, the auditor needs to inquire how management is going to address the matter in the financial statements. In other words, how are the financial statements going to be amended and how are they going to be affected, right? So let me repeat. The auditor responds to subsequent events So those facts which are discovered after the date of the auditor's report, but before the financial statements are issued, right? So that period of passive duty, right? The auditor must discuss with management, or where appropriate, those charged with governance, and the auditor must determine whether the financial statements are going to be amended. And if they're going to be amended, the auditor must inquire from management how that particular amendment is going to affect the financial statements, right? So if amendments are made, the auditor needs to carry out procedures on those amendments, right? And when the auditor carries out those procedures on the amendments, you know, it needs to release a new report. So after those amendments are made, so the report has already been issued, but the auditor has come across facts which were not known before. But if those facts were made known before the audit report was issued, right, then the auditor could have amended the report. So it needs to carry out audit procedures on those particular adjustments. Then it also needs to release a new report. Now, if amendments are not going to be made, so if the auditor discusses with management, it determines how the financial statements are going to be amended, and it inquires how those amendments are going to affect the financial statements, but management does not make those amendments. The auditor needs to react as follows. So if the auditor still has the audit report in its premises, it needs to modify its opinion. So don't worry about this modify. We're going to look at it as we progress. So the auditor needs to modify. So modification of an opinion simply means the auditor needs to change the opinion. So if the opinion was unmodified, it concluded that the auditor concluded that everything in the financial statements is okay and everything has been prepared according to how it's supposed to be prepared. The auditor is supposed to modify the opinion, given those facts that have been discovered, right? Then the auditor needs to inform management not to publish the financial statements until amendments have been made. So if the audit report has been already submitted to the client, the auditor needs to find a way to ensure that third parties do not place reliance on the audit report. Right? I don't know if you have any questions so far.
No questions, Mr. Patrick.
Okay, so now, for so now that's sometimes the audit report, or rather the financial statements, have been issued right to the public. Then the auditor discovers certain facts, which if they were made known during the period during the active duty, you know, they could have led to a change in the audit report or amending the audit report. All right. So again, the auditor needs to discuss the matter with management, or where appropriate, those charged with governance. Then the auditor needs to determine whether financial statements need amendments, and if so, the auditor needs to inquire how management intends to address the matter in the financial statements. So for this one, this is where financial statements have been released, all right? But there are certain facts which have been, which the auditor has come across, which if the auditor had known prior to those financial statements being released, they could have led to a change or to amendment in the report, right? So if management is going to make amendments to the financial statements, the auditor needs to carry out audit procedures necessary in the circumstance. One, so after carrying out the audit procedures which are necessary in the circumstance, the auditor needs to review the steps taken by management to inform the situation to those who had already accessed the financial statements. So before the financial statements were released, then some facts or maybe a misstatement has been discovered after financial statements have been released. But those financial statements have already been accessed by different individuals, right? And that's why the auditor needs to review the steps management has taken to inform the situation to those who have already accessed the financial statements and the audit report, right? Then the auditor needs to extend procedures to the date of the new auditor's report, right? So the auditor needs to also extend the procedures to the date of the new auditor's report. So until the date when the new audit report is released, the auditor needs to make sure it's carrying out the necessary procedures to obtain sufficient appropriate evidence. Then after, the auditor needs to release a new report on the revised financial statements. So management has amended the financial statements, so the auditor needs to release a new report on those amended financial statements, right? And lastly, the auditor must include an emphasis of matter paragraph or other matters paragraph in the new report referring to the note in the financial statements, right? So if those amendments have been made, the auditor needs to inform the user saying, wait, these financial statements or this report that has been released, it's a second report given these facts that we discovered after the financial statements were released. So it needs to include an emphasis of matter paragraph or other matters paragraph in the new report. So don't worry about these. We're going to come across them uh, as we progress with our lesson. I don't know if you have any questions so far.
No questions, Mr. Patrick.
Okay. So let's look at going concern. So this is very, very important. I think you need to pay optimal attention. So, what is going concern? So, initially, according to the financial accounting framework or financial reporting framework, financial statements are supposed to be published or released on a going concern basis. So, what does a going concern basis mean? It means financial statements, they need to be prepared as though the business is going to be existent in the foreseeable future. So they prepare financial statements like the entity is going to be alive for the next 10, 15, 30, 35 years, even 50, 100 years. That's the assumption, right? That's the going concern basis. Financial statements are prepared on a going concern basis, which means an entity is deemed to be operational in the foreseeable future, right? When a company is not a going concern, financial statements must be prepared on a breakup basis. So when the management has discovered that financial statements will not be prepared on a would not be prepared on a going concern basis. It has to be prepared on a breakup basis. So when financial statements are prepared on a breakup basis, right? Long-term liabilities are recognized as short-term, right? Then assets are held at their realizable value. So this is something you should be able to explain when you come across a good concern question. So, one, financial statements are supposed to be prepared on a going concern basis, meaning the entity is deemed to be operational in the foreseeable future. That's one. Then number two, when a company is not a going concern, the financial statements must be prepared on a breakup basis, meaning the long-term liabilities are supposed to be recognized as short-term, then assets are, are held at the realizable value, right? Then now, what are the objectives of the auditor with respect to going concern? So the auditor needs to, one, obtain sufficient appropriate evidence whether the entity should continue to prepare financial statements on a going concern basis, right? Then two, the auditor needs to conclude from the evidence obtained whether material uncertainty exists which may affect the going concern of that particular entity. Then three, the auditor needs to report in accordance with the IASA 550. But in exam, this is not really as relevant, right? But to show the audit, the examiner that you know exactly what you're writing, you can include that. But yeah, but you saying report in accordance with ISA is enough. So these are the objectives of the auditor. Sometimes you'll be asked, what are the objectives of the auditor with respect to going concern? And the objective of the auditor is one, to obtain sufficient appropriate evidence that the financial statements, or rather, the entity must continue preparing financial statements on the going concern basis. So to obtain sufficient appropriate evidence, then two, to conclude from the evidence obtained whether material uncertainty exists, which may affect the going concern of the entity. Then three, report in accordance with the ISA 570. So this is very, very important when it comes to going concern questions. Then now, there are certain examples that you can be able to cite that may reflect that the company has got going concern issues. So sometimes in the exam, you're given a scenario, then there are these different scenarios. So sometimes the examiner combines business risk as well as going concern. So they're just different scenarios that are put in the question. Then you need to cite those that affect the going concern of that particular company. So examples. So one, their financial conditions, their operational conditions, as well as the other conditions which affect or maybe which may reflect the going concern issues in a particular entity. So financial conditions, one, net liability or net current liability position. So if the company has got a lot of net liabilities, or a company has got a lot of current liabilities given with in comparison to the current assets. So if you calculate the current ratio, if the current ratio is low, if the company has got more current liabilities, it means there's a problem, or maybe that's an indicator of the going concern problem, that particular entity, right? So two, necessary borrowing facilities have not been agreed. So a company needs borrowing, it needs funding for it to operate effectively, but the necessary borrowing facilities have not been agreed. Then there's a going concern problem there. Then the fixed term borrowings approaching maturity without realistic prospects of renewal or repayment, or excessive reliance on short term borrowing. So the company has borrowed money, has got a loan for 5 years. That loan or bond is approaching maturity, but the company has no source of funds to offset that particular maturity of the loan. Then, then there's a chance that there's a going concern problem. Why? Because when the borrowers, or rather the lenders, they request for liquidation, that company will no longer be a going concern. Then major debt repayment is falling due, where refinancing is necessary to the entity's continued existence. So the company is facing financial troubles, right? It needs money to be pumped into that particular business, right? But at the same time, the amounts that it borrowed, they are falling due. So it simply means that entity won't be able to pay off its debt. It means it's going to have a going concern problem, because if the lenders take the company to court and they request for their money, that particular company is going to be liquidated. Then the other examples, like major debt restructuring, adverse key financial ratios, inability to pay payables on due dates, inability to comply with loan agreements. So in the exam, just need to make sure you are alert to these conditions, which may result in going concern problems. So when you go through questions, you'll be able to easily cite these uh, these these going concern indicators. Then two, operational indicators. So operational indicators include one, loss of key management without replacement. So a company is losing key management, but they are unable to replace the key management. Then there's a going concern problem. Then loss of key staff without replacement. So the turnover of a company, or the turnover in the company, is quite high. but at the same time, the company is unable to replace those employees that are leaving. So it means there's a going concern problem. So loss of major market, a company has got a major market. Maybe it's a manufacturing company, then it produces drinks, and its largest market students, university students. Then a competitor comes into the market and takes majority of the students, and it's no longer selling the drinks to that particular market. Then it means that company has a going concern problem. Then the labor difficulties or shortage of important supplies, maybe the problems with the supply chain, the necessary raw materials for production, they're not coming in time. Maybe there's poor supply. Then it means the company is going to have a going concern problem because it won't be able to meet demand. And if it can't meet demand, it means it won't make enough sales for it to survive, right? So then the other indicators include non-compliance with capital or other
Mm.
statutory regulations or requirements. Then there's pending legal procedures against the entity that may, if necessary, result in company losing license. So changes in legislation or government policy. So other indicators can also include maybe technological changes. So I'll give an example of Nokia or BlackBerry. So technological changes, the development of technology, led to Nokia uh, going out of business. It no longer became a going concern. So if there may be adverse changes, there's a lot of competition. It may also be a reason, or it may also be a point which may indicate the going concern problem of a company. I don't know if you have any questions. Hello? Hello?
No question.
Yeah, can you get me? You can get me? Can I carry on? Okay. All right. So let's carry on. Thank you. So now, okay. So let's look at the auditory.
Hello.
Yeah, I can get you. I've seen the message.
Hello.
Yes, I've seen the message.
I'm saying no questions.
Okay, okay. All right. So let's look at the audit report with respect to going concern. All right. So now, if material misstatement in relation to going concern is a key audit
Hello.
matter. Yes, I can get you. Can you get me?
I get
No, you're skipping, but just.
getting
Okay, I carry on.
me.
I carry on. Hello.
Hello. Are you
I can't get you clearly. No, I can't get you.
getting?
No, I can't get you.
Hello,
Okay, I can't get you,
Mr.
but
Patrick.
I can't get you clearly. Hello.
Yeah,
Okay, so let me proceed. Okay,
yes, I
so we're looking at the audit report with respect to going concern. So now,
can get
how, how is going concern reported?
you.
Yeah, how is going concern reported? So when the going concern basis of accounting is appropriate and material uncertainty has been disclosed in the financial
I
statement.
can get you.
Okay, so let me carry on. Uh, so how do we report going concern? How do we report going concern? So one, when the going concern basis of accounting is appropriate and material mistake uncertainty has been disclosed in the financial statements, the auditor needs to express a modify. Okay, okay. So when material misstatement, so when the going concern basis of accounting is appropriate, right? In material uncertainty has been disclosed. So the going concern is appropriate. The company needs to record its transaction, or rather it needs to prepare its financial statements on a going concern basis. But there's material uncertainty, right? The auditor needs to express an unmodified opinion containing a paragraph code material uncertainty relating to going concern.
Yes,
So when the going concern basis of accounting is appropriate, the company can issue its financial statements on a going concern basis. But there's material uncertainty due to one condition or the other. Maybe it's got high level of debt, or uh, some or its borrowings are falling due, and it has no possible ways of paying. But that particular uncertainty has been expressed in the notes to the financial statement. The auditor needs to express an unmodified opinion containing a paragraph called material uncertainty relating to going concern, right? Then two, if the going concern basis of accounting is appropriate, but the material uncertainty has not been disclosed adequately. So the company is not, or rather, the company is supposed to, or maybe due to the auditor's evidence obtained, the company can continue preparing its financial statements as going concern, but there's material uncertainty, and that material uncertainty is not disclosed adequately, then the auditor needs to issue a modified opinion, right? Either a qualified or adverse opinion according to the extent of the uncertainty, right? So the going concern basis is appropriate, but there's material uncertainty, and that material uncertainty is not disclosed, then there's supposed to be a modified opinion. So it can either be qualified or adverse depending on the extent of the uncertainty. Then, if going concern basis of accounting is inappropriate, so the company, the auditor has established that the going concern is not appropriate. The going concern basis of accounting is not appropriate. The company is not supposed to be prepared on a going concern basis. It needs to be prepared on a breakup basis, right? It means the auditor needs to issue an adverse opinion whether management has disclosed the material uncertainty or not. So an adverse opinion simply means the financial statements have got a material misstatement, and that material misstatement is pervasive to the financial statements. When we're going to understand this further as we approach uh, the other aspects of the topic, or the lesson rather. So then the last point, management is unwilling to make or is unwilling to make or extend its assessment of going concern. So what usually happens at the beginning of the audit, at the risk assessment stage, the auditor needs to have a meeting with the management, to confirm if they've carried out a risk, if they've carried out an assessment of the going concern of the company, right? So now, sometimes the company can carry out an assessment for a period that's less than 12 months, maybe just 6 months, right? You've just carried out the going concern basis for a company, or for a period that is less than 12 months. Then the auditor needs to request management to extend the assessments to at least a period of 12 months. And if management refuses or it's unwilling to extend that assessment, then the auditor needs to express a qualified or disclaimer opinion.
Yes.
All right. So now, let's look at written representation. What are written representations? So written representations are written from management to auditors to confirm certain matters or to support other audit evidence. So written representations, these are just confirmations which are written from management to the auditor to confirm certain matters or to support the audit evidence that has been provided.
Yes. Continue.
The auditor can obtain written representations on the following. So the management can make, or rather,
Yes.
the written representation can be one for confirmation that,
Hello, I can get you, Mr. Patrick.
yeah. So management. So we're looking at written representations. So written representations are written from management to the auditor to confirm certain matters. So when the auditor is unsure about certain aspects of the audit or the audit evidence obtained, the auditor can ask for management representations, right? Then two, um, at the beginning of the audit, the auditor requests management to prepare management representations so that management express knowledge of their duties, right? So uh, written representations are presented for one, confirmation that management has presented and prepared the financial statements in accordance with the terms of the audit engagement and the financial reporting framework. So management needs to confirm that they've prepared the financial statements accordingly to how the auditor and management agreed in the audit engagement contract, as well as they've prepared the financial statements according to the financial reporting framework. That's the first management representation that the management can issue to the auditor. Then two, management needs to confirm that they have provided the auditor with all relevant information agreed in the terms of the engagement, and all transactions have been recorded and are reflected in the financial statements. All right. So the auditor needs to request, or rather, management needs to issue written representations to the auditor that everything, all the items, all the evidence that's required, the auditor, rather the management has presented the necessary information to the auditor, right? Then written representations required by the international standards on auditing. So the auditor can request for written representation on all matters relating to fraud. That management is aware of, or rather is not aware of any events of fraud, or all the events of fraud that have occurred in the business. They've been presented to the auditor, and everything that management knows about fraud in the company, they have told the auditor, right? That's number one. Then also written representations about compliance with applicable rules and regulations. So management also needs to issue uh, management representations to confirm that they have applied, or rather they've complied with all the necessary rules and regulations as acquired by the relevant statute. Right? I don't know if you have any questions so far.
No questions, Mr. Patrick.
Okay. Now you're clear. I don't know what happened. There was a problem with network.
I think so.
Yeah. So now we're going to look at overall evaluation. So overall evaluation at the end of the audit, overall evaluation is done at the end of the audit process. The auditor gets a copy of the draft financial statements and evaluates them vis-a-vis the audit evidence. So the auditor gets all the evidence that has been obtained, then they're evaluated vis-a-vis the financial statements, and the evaluation is carried out on. So the auditor needs to check compliance with the accounting regulations. Is the company complying with the necessary rules and regulations? And two, the auditor needs to review consistency and reasonableness. So the auditor needs to review the consistency between their knowledge of the entity's business as well as the financial statements. So the consistency between the two, the auditor needs to review it. Then also analytical procedures. So the auditor needs to perform analytical procedures. This involves ratio analysis and all other comparative information. The auditor needs to make sure it carries out those analytical procedures at the overall evaluation, right? So now let's look at the auditor's report. So the elements of the audit report. So sometimes you can be asked, can you explain any 6 elements of the auditor's report, right? So you need to have knowledge of any of these. So some of the elements of the auditor's report is one, there's a title. So there's the addressee, there's the opinion paragraph, there's the basis of opinion, then there's the going concern, then there's the key audit matters, there's the name of the engagement partner, then there's address as well. So these are just some of the elements of the auditor's report that you need to memorize and know so that you can be able to write in the exam. So one is supposed to be a title. So what is contained in the title? So the title outlines that the report is an independent auditor's report and signifies that the auditor met all ethical requirements. That's the title. Then two, the addressee. The addressee paragraph states whom the audit report is prepared for. It's usually determined by the law, but in most cases, it's the shareholders and those charged with governance. So the addressee is just whom the particular audit report is targeted at. Who is the auditor preparing the audit report for? Then the opinion paragraph, it outlines the audited entity, a statement that the entity has been audited in accordance with the ISA and the accounting policies and period of review. So it just outlines the entity that's been audited. There's a statement that the entity has been audited in accordance with the ISA and the accounting policies in the period of review, right? Then there's also the basis of opinion. It highlights the benchmark under which the audit was conducted. So it includes maybe the ISA, which is the International Standards on Auditing, uh, and also the auditor's responsibility for the audit. So basically, the basis of opinion is it highlights the benchmark under which the audit was conducted. Then the going concern paragraph. Here, the auditor considers the material uncertainty related to going concern of the entity, uh, if at all it exists. So the going concern paragraph, or rather the going concern part of the audit report, so it just outlines, it considers the material uncertainty related to the going concern of the entity. So if there's any material uncertainty that this entity is not supposed to be a going concern, then it's outlined in the going concern paragraph. Then key audit matters. These are matters which, according to the auditor's professional judgment, were of extreme importance in the review period. So all those matters which were very, very important according to the auditor, they are included in the key audit matters, and this key audit matters is only for listed companies. Then the name of the engagement partner must always be included in the auditor's report unless there's material risk to the life of the engagement partner. So if you check the auditor's report, there's always the name of the engagement partner. So if you read Zanaco financial statements, you read the auditor's report from PwC, you discover that the engagement partner is Andrew Chibuye and he signs there. Then address of the auditor, which is primarily the address of the audit partner or the audit firm or both. So these are the elements of the audit report that you need to memorize in case you are asked, so that you can be able to answer. I don't know if you have got any questions so far.
No questions, Mr. Patrick.
Okay, so there's also what we call the key audit matters. We already talked about the key audit matters here. So let's just dive deep on the key audit matters. So the key audit matters focuses on the following areas. The areas with a high risk of material misstatements, right? So all those areas in a business which may result in high material misstatements, maybe provisions or assumptions or anything relating to management's judgment, you know, these are included in the key audit matters. So relation of key audit matters with the audit opinion. So matters which result in the audit opinion being modified should not be included in the key audit matters. So all those matters which may result in the audit opinion being modified, they should not be included in the key audit matters, right? Then matters which give a rise to material and states the certainty about the going concern of the client must also not be included in the key audit matters. So anything relating to the going concern of the company, any material uncertainty relating to the going concern of the company must not be included in the key audit matters of the audit report. Then key audit matters paragraph must not be included in the audit report if the auditor disclaims the opinion. So if a disclaimer of opinion, I think I will explain it at the end, is where maybe, not maybe, but this is where the auditor has obtained sufficient, has not, has obtained sufficient, like, so the auditor has not obtained sufficient appropriate evidence that the financial statements are misstated and that that misstatement is pervasive to the financial statements. So due to scope limitation, the auditor can't conclude that these financial statements, they are misstated and the misstatement is pervasive, right? But I will explain it at the last part of the lesson. But yeah, so if the auditor disclaims an opinion, then it must not include the key audit matters paragraph. Then also emphasis of matter paragraph. So what are emphasis of matter paragraph? So in this paragraph, the auditor tries to highlight something important in the financial statement that the users should pay special attention to. So anything that's important that the auditor feels the users should pay attention to in the financial statements that are included in the emphasis of matter paragraph. That's why it's called the emphasis of matter. So all those aspects that the auditor deems to be important, um, they're included in the emphasis of matter paragraph. So if the matter has been included in the Q audit matters paragraph, it must not be included in the emphasis of matter. So if that matter has been included in the key audit matters, it need not be included in the emphasis of matter, no matter how important it is to the user's understanding. The matters relating to the entity's going concern should not be included in the emphasis of matter paragraph, you know. So all those items or all those matters, all the conditions which are relating to the going concern of the company, they need not be included in the emphasis of matter paragraph. All right. So for example, uncertainty relating to future litigation or legal action. So these are some of the situations that may lead to an emphasis of matter paragraph. So maybe a company has been sued, there's a provision that has been provided, but there's uncertainty about that provision going through. and the auditor needs to include an emphasis of matter paragraph. Then other matters paragraph. This is a paragraph in the auditor's report which refers to the matters other than those presented and disclosed in the financial statements which are relevant to the user's understanding uh, of the audit, responsibilities of the auditor, or auditor's report. So sometimes there's what we call the expectation gap. Um, the users don't really know the work of the auditors. Sometimes the users of the financial statements, they think or they believe that the auditor's job is to make sure everything in the business is operating accordingly. But to explain that to the users, to explain the duties of the auditor to the auditor can include other matters paragraph just to make sure the users understand the role of the auditor and the functions of the auditor with respect to the financial statements. I don't know if you have got any questions so far.
No questions.
Okay, so now we're going to look at pervasiveness. You need to also understand pervasiveness. What is pervasiveness? So, pervasiveness simply refers to how widespread or significant an issue is in the financial statements. So, how important is an issue in the financial statements? So, if an issue is important, it's very important, it affects financial statements or many components or maybe many items or many parts of the financial statements, then that issue is pervasive. So a pervasive item occurs if a problem affects many parts of the financial statements or is so serious that it makes the entire financial statements unreliable, right? So that item which makes the financial statements unreliable because it affects many aspects of the said financial statements, then that issue is pervasive, right? So a pervasive item, let me emphasize, refers to how widespread an item or how significant an issue is in the financial statements. And the pervasive issue affects many parts of the financial statements, and or it's so serious such that it may make entire financial statements unreliable, right? So now we're going to use this pervasiveness, the understanding that we've obtained from the meaning of pervasiveness is what we're going to apply in the audit opinions. So now at the end of the auditor needs to express an opinion. All right. So there are about four audit opinions that the auditor can express. So one, there's an unmodified opinion. So an unmodified opinion is expressed if the auditor believes that the client's financial statements have been prepared in all material respects in accordance with the applicable financial reporting framework. So an unmodified opinion simply means everything is okay, everything is fine. The auditor has carried out the procedures, the auditor has undertaken all the necessary procedures, and the auditor believes it has obtained sufficient appropriate evidence that the financial statements have been prepared according to the applicable financial reporting framework, that everything is okay, there's no problem that are material to the financial statements, then the auditor expresses an unmodified opinion. Then qualified opinion is also called an except for opinion. So the auditor has obtained sufficient appropriate evidence to conclude that the financial statements are materially misstated, but the material misstatement is not pervasive to the financial statements. So the auditor has obtained financial, or rather, the auditor has obtained sufficient appropriate evidence that there's a material misstatements that is present in the financial statements, but that material misstatement is not very widespread. It's not affecting a lot of items in the financial statements. It's not very, very significant, but the material misstatement exists, right? Then the auditor expresses a qualified opinion. So a qualified opinion results when the auditor has obtained sufficient appropriate evidence to conclude that the financial statements are materially misstated, but that misstatement is not very significant or it's not very pervasive to the financial statements. Then there's also what we call the disclaimer of opinion. So a disclaimer of opinion, as I already explained, is expressed when the financial statements have been materially misstated, but the auditor has not obtained sufficient appropriate evidence that the material misstatement is both material and pervasive to the financial statements. So, due to one reason or the other, the auditor has had a scope limitation, right? The auditor cannot fully express that uh, the entity, or rather the financial statements that materially misstated, and that material misstatement is pervasive to the financial statements. Why? Because the auditor has not obtained sufficient appropriate evidence. There's a scope limitation. Then the auditor needs to express a disclaimer of opinion. Then an adverse opinion is expressed when the auditor has obtained sufficient appropriate evidence to conclude that the material misstatement is both material and pervasive to the financial uh, statements. So there's a misstatement in the financial statements, there's a misstatement in the financial statements, and that misstatement is both material and pervasive to those financial statements. Then the auditor can express an adverse opinion. With that said, our lesson has come to an end. I don't know if you have any questions.
No question, Mr. Patrick.
All right. Or adjustments or clarification.